Oil prices jumped 2.5% as tensions between Iran and the West escalate. Military exercises in the Gulf by Iran and the movement of US naval vessels in the area have raised fears of confrontation between Tehran and Washington and a disruption to world oil supplies. The euro also in focus today, rising back above 130. There's no easing up of the eurozone financial crisis, but investors start to wonder whether the record bets amassed against the single currency may be too extreme. This is Trading at 12, and I'm joined in the studio by Reuters market analyst and commodities specialist John Kemp and Reuters FX analyst Neil Kimberley. John, I'd like to start with you. A 2.5% move up in oil. It's among the biggest movers today across all asset classes, based all on this political tension between Iran and the West. In previous years, though, this kind of tension would have triggered a higher increase in the price of oil. Why not now?
I think the market is very sceptical about whether or not a confrontation will ensue. We have been here sort of many times, 5 or 6 times over the last decade, and in every case the tensions have eased afterwards, so the market's very sceptical. I think the market's also struggling to make any sort of progress because the geopolitical risks associated with Iran are being offset by a lot of negativity about the state of the economy, and also hope for large new oil supplies coming out of the shale boom in the United States.
So you think that political risk and this geopolitical tension in the Gulf area is the only real source of support for oil. How long can this last? Essentially, how much of the oil price is that risk factor?
I think that risk factor is probably currently accounting for $10 or $15 on the price of oil. I think if we didn't have Iran risk, then I think Brent would be at $100 or possibly even slightly lower. How long it can last? My guess is that the political risk premium can only stay in there for a couple of months at most, unless we actually see some kind of dramatic escalation on the ground.
Now, we spoke earlier and you said that if we do see that kind of dramatic escalation, all bets are off. What does this mean in terms of the oil price? Are we talking about new highs for oil?
I think we would see a very sharp spike, but I think it would be quite short-lived, because I'm almost certain that if there were to be a military conflict of any sort, then that would probably trigger an immediate release of SPR oil. So any price spike could be quite big, but probably quite short.
Okay, Neil, I'd like to turn to you. The dollar's coming off second best in this FX and commodity spin today. Is that what's pushed the euro back above 130?
Well, funnily enough, some of the Middle East guys I spoke to this morning were saying that below 130, given the tensions in the Gulf with Iran, they saw it as a reason to pick up a few euros. So that helped. But just as the sort of pre-Christmas, Christmas to New Year period is characterised by US exporters buying dollars for year end, the start of the new year is often characterised by new capital coming in for real money and being put to work. And that's generated a more general risk appetite this morning. You can see it in euro dollar, you can see it in Aussie dollar, and that's led to a lot of stop losses being hit.
Now, one of the big talking points in the FX market, specifically on the euro, is positioning. As you know, the latest IMM data show 128,000 net short contracts. That's a record $21 billion leverage bet against the single currency. Surely it's time for a squeeze higher, isn't it?
It's possible you're starting to see that squeeze this morning, albeit there are a lot of Asian investors who are telling me they have an interest to sell a lot of euros between 130.5 and 131 figure. And if you're looking for other reasons to justify the risk market, is look at what's happening with the Federal Reserve. You've lost 2 hawks at the beginning of 2012, Mr. Plosser and Mr. Fisher. Mr. Lacker's coming in, but he's the only hawk I can see. If it starts to stall in the States, it seems much easier for me if Mr. Bernanke can push through QE3. So if you're looking for reasons for the risk rally, you don't just have to look at the positioning, but that is skewed.
Okay, very quickly and finally, from where we are today, the euro just around 130, do we see 125 before we see 135?
125, because nothing's changed. I've spoken to a number of banks this morning. The fairy godmother has not waved the magic wand. They don't all trust each other, they're not lending, and the periphery is in the same mess as it was at the end of the year. Why would I want to buy too many euros?
Okay, thank you very much. Gentlemen, that's it for now. My thanks to Reuters analyst Neil Kimberley and John Kemp. I'm Jamie McGeever. This is Reuters.